We think we're still in a bull market. And we believe that the deregulation that we're seeing here in the United States is going to be very important to institutions moving into this new asset class. Asset allocators have to have a point of view on this new asset class. And we think by putting it in portfolios, risk-adjusted returns for the entire portfolio will go up.
Despite Treasury Secretary Janet Yellen's recent statement that the U.S. is not heading into a recession, Cathie Wood argues that the economy has been experiencing a rolling recession. This means that different sectors have been going through downturns at different times rather than the economy declining all at once. Wood points out that the velocity of money, the rate at which money circulates in the economy, is collapsing. People, particularly those in quasi-government sectors like education and healthcare, are increasingly concerned about job security, leading to higher savings rates and lower consumer spending.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
So one of the things we think is going on right now is, and Treasury Secretary Yellen today said he does not believe that we're going into a recession. We think we've been in a rolling recession and that we are actually going to see some negative quarters here. And that's because the velocity of money is collapsing as people, the labor force is worried that, and we're talking about federal, state, and local, quasi-government categories like education and healthcare. There's a lot of fear around job security right now. So we see the saving rate going up. We see the velocity of money coming down, and we do think we'll see one or two negative quarters. What we believe that will do is set this administration up and the Fed up with more degrees of freedom for tax cuts and perhaps lower interest rates, or at least ending quantitative tightening. If we're right, and inflation is going to surprise on the low side of expectations, we wouldn't be surprised to see 2 or 3 cuts. Now, if you look at an indicator called trueflation, it's probably the broadest measure of inflation out there. It is saying inflation is down to 1.65%, well below where the Fed is pinning it at roughly the CPI's 2.8%. And we believe that the combination of actually food prices have started coming down. Even egg prices have started to collapse, as a matter of fact. Gasoline prices are coming down. We're seeing some rent prices coming down. So we think inflation is going to surprise on the low side of expectations for those reasons, and because innovation is inherently deflationary. And our 5 innovation platforms are all driving different kinds of deflation. Good deflation, which will cause unit growth, but deflation nonetheless. So we think the Fed is going to have many more degrees of freedom in the second half of this year than most people think. We could see more than the number I just suggested, 2 to 3 cuts. Yes, it is our view. I think right now we're in a risk-off period generally. And if you've been watching Bitcoin, it's almost been a leader in terms of risk on, risk off. So I think that's what we're seeing. If you look at our on-chain analytics, what you will see is that we are in the middle of, we're a little bit more than halfway through a 4-year cycle. We think we're still in a bull market. And we believe that the deregulation that we're seeing here in the United States is going to be very important to institutions moving into this new asset class. Asset allocators have to have a point of view on this new asset class. And we think by putting it in portfolios, risk-adjusted returns for the entire portfolio will go up. I think the Trump family is very supportive of crypto, which is great. It's completely different from the environment we had been in. Our view on meme coins, we're not as focused on them. We would not be putting them into our various private funds because, and I think that the combination of AI and blockchain technology is creating millions of these meme coins. We think most of them are not going to be worth very much. We think there are just going to be a few crypto assets that will gain most of the spoils in the entire ecosystem. Well, I think that the SEC did a very important thing in declaring these meme coins not securities. What they essentially were saying is, we are not going to regulate them, and it's buyer beware. And so if I have one message for those listening who are buying meme coins, buyer beware. And I think the message is loud and clear from the regulators. What we think will happen is there will be some fearsome declines in the prices of some of these meme assets. And, there's nothing like losing money for people to learn. And they'll learn that the SEC and regulators are not taking responsibility for these meme coins. The millions of meme coins will probably end up worthless. So when we're talking about the big three, we're talking about Bitcoin, Ethereum, Solana. The use cases for those are multiplying. And we think they're going to become very important in the years ahead. Meme coins, not so.
Cathie Wood believes that digital wallets will play a crucial role in the future of financial services. She compares them to credit cards, suggesting that most individuals will only use a few dominant wallets. She identifies Robinhood and Coinbase as two leading contenders, with Robinhood excelling in user experience and Coinbase focusing on crypto-first adoption. She also discusses the tokenization trend, pointing out that Larry Fink, CEO of BlackRock, has expressed interest in tokenizing financial assets.
Meme coins will be collector's items, so digital collector's items. And so, of course, some will withstand will withstand the judgment of time, and that may be one of them. But our working assumption is that when you're talking about millions of meme coins, that that's just a step too far, and that most of them are not going to be worth very much. I think what is happening with the stablecoin movement, which again, we're going to see deregulation and legislation this year, we think, which will open the doors to stablecoins. So USDC, that's Circles, USDT, that's Tethers. That's the on-ramp into DeFi, decentralized financial services. So you're already seeing lending and saving and yield harvesting taking place on these ecosystems, which are supported by Ethereum and Solana. And of course, you're seeing wrapped Bitcoin on Ethereum as well. So Bitcoin's trying to get into the game. But in terms of real utility, if you go to emerging markets, and I know this is not this market, but you go to emerging markets where their currencies destroy purchasing power and wealth with massive devaluation. So it's really their policy leaders. They are using Bitcoin in particular, but also stable coins, which is effectively the dollar, as backstops to their purchasing power and wealth, because they've been through too many of these devaluations. So I think the real utility, if you're looking at stable coins and Bitcoin today, is in the emerging markets, really protecting consumers' purchasing power and wealth. Well, our main thesis for both is we're looking for the winners in the digital wallet space. Most of us are not going to have many wallets. You can think about this in the same way you think about credit cards. Most of us don't have very many credit cards. So we're looking for those winners. And, Robinhood and Coinbase are coming at this from different angles. Of course, Coinbase from the crypto first angle, and Robinhood from more the equity end of the spectrum. Both of them have to. Robinhood has nailed the user interface. I think Coinbase is putting a lot of effort into getting that right as well. So we're looking at them as two of the bigger winners. In terms of our own venture fund. And we did start an interval fund, which is a 40 Act fund. I mean, we could see tokenizing that, putting it on chain, and enabling many, many more people to get involved with the private world. And I think other venture capital firms could do much of the same thing. I do agree there's going to be a lot more competition, a lot more ways to fund new companies. So that is true as well. So I'd say this new world's going to be complicated. When we hear Larry Fink of BlackRock saying he wants to tokenize everything, it's big because it takes a lot to move the needle at BlackRock. So we're watching the tokenization movement very closely for our own purposes as well. We have been known for our Tesla call and our Bitcoin call, and those still stand as two of our biggest calls. For sure. I would add, in the AI age, platform as a service companies like Palantir, which are really enabling large enterprises to move into this AI age and enjoy the efficiencies, the cost effectiveness, and to create new products and services. Those, I think, are going to be very big as well.
Cathie Wood reaffirms ARK Invest's long-standing bullish positions on Tesla and Bitcoin. She adds that AI-driven platform-as-a-service companies such as Palantir will also play a crucial role in the next technological era. These companies enable enterprises to leverage artificial intelligence for efficiency, cost-effectiveness, and product innovation. Wood remains confident that innovation will continue to drive economic growth and that disruptive technologies will reshape traditional industries. She encourages investors to focus on long-term trends rather than short-term market fluctuations. Please like and subscribe.